Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And today we are looking at an absolute collision of high-tech fraud, macroeconomic headaches, and honestly some pretty brutal regulatory crackdowns.
Yeah, it's an incredibly volatile week.
It really is. I mean, we've got AI-generated liar loans that are just tearing through the Australian market. We've got the Bank of England staring down this impossible September rate dilemma.
Right.
And on top of that, there is a shocking £1 trillion blind spot in the UK wealth management sector.
Which the regulator is furiously circling, by the way.
Oh, absolutely. Throw in regulators ruthlessly hunting down individual executives, plus the U.S. making a massive play for global crypto dominance, while HMRC brings out the tax hammer. It's a perfect storm for compliance and risk schemes.
It really is. But, before we look at those individual sector risks, we absolutely must establish the intense macroeconomic pressure cooker that UK banks are operating in right now.
Right.
Because the macro backdrop, it's the engine driving the risk in everything else.
Yeah, let's get into the mechanics of that, because the latest numbers are giving everybody whiplash.
They are.
I mean, the Office for National Statistics just reported that unemployment from April to June 2026 has edged up to 4.9%.
Uh-huh.
So that's up 0.2 percentage points on the year. And vacancies are dropping down to about 707,000. So if you just glance at the headline, the story looks like a cooling labor market, right? Like the brakes are finally working.
They are, but only on one axle. Because then you look at pay growth, which is just stubbornly refusing to cooperate with any tidy sort of economy is slowing narrative.
Right.
Regular earnings rose 3.5% on the year, and total pay, which includes bonuses, obviously that rose 4.1%.
Wow.
Yeah. Adjusted for inflation, real pay growth is sitting comfortably positive. So people are losing jobs, but the people keeping their jobs are getting really expensive pay bumps.
Which means if I'm sitting on the Bank of England's Monetary Policy Committee right now, I'm having an absolute nightmare scenario.
Oh, absolutely.
Because back in July, they held the bank rate at 3.75% in a very tight 6-3 split.
Yeah.
And the Doves look at that 4.9% unemployment and they want to cut. But the Hawks look at 4.1% wage growth and they want to hike.
Yeah.
It literally feels like driving a car where you have one foot slamming the brake and the other foot is just jammed on the accelerator.
That is a brilliant analogy, and it's frankly tearing Treasury teams apart right now because asset and liability management desks at retail banks, they price their mortgages and their savings products off these expectations.
Right.
And when the central bank is this cleanly split, the market just desperately hunts for any external signal to price in. And we actually saw some momentary, highly deceptive relief this week when the US Treasury stepped in to calm global bond markets with this tactic everyone's dubbing a mini QE.
Yeah, the U.S. Treasury really surprised the markets by announcing they're going to double the size of their liquidity support buyback operations.
Mm-hmm.
We're talking specifically about longer-dated securities.
Right, the 10 to 30-year segment.
Yep.
Exactly. Lifting the maximum per operation to at least $4 billion. And we saw an immediate sympathetic reaction in London, didn't we?
We did.
UK 10-year gilt slipped back to around 5.05%.
But here is why UK Treasury teams cannot over-rely on that U.S. intervention. You really have to understand the mechanism of what the U.S. Treasury is actually doing.
Okay, break that down.
It is a tactical duration swap.
Yeah.
It's not a regime change. It's just a temporary circuit breaker.
Yeah.
I mean, the U.S. Treasury cannot create money out of thin air the way a central bank does during actual quantitative easing.
Right, they aren't the Fed.
Exactly. To buy back those long-dated bonds, they have to finance it by issuing more short-term bills elsewhere. So they were just reshaping the maturity profile to cap disorderly yields at the long end. They aren't shrinking the net supply of debt.
Which explains why, despite that relief rally in bonds, the FTSE 100 closed only modestly higher and then actually dropped 0.25% the very next session. The market isn't buying it as a permanent fix. Precisely. Because UK investors remain entirely anchored to our own elevated gilt levels. I mean, our sticky wage inflation, our uncertain growth. The key takeaway for UK banks is that you just cannot treat this short-term volatility dampener from Washington as a structural cure for London.
Yeah.
Banks absolutely must stress test their affordability models against both a hold and a further hike scenario for that 17 September MPC decision. Do not assume the era of high-term premia is magically over.
Well, and it's that intense, prolonged pressure on affordability that connects directly to our next topic, which is the integrity of the mortgages themselves.
Right.
Because when rates stay high and standard variable rates really start to bite, affordability criteria get incredibly tight. And when affordability gets tight, the incentive to manipulate applications just skyrockets. Which brings us to the absolute mess happening in Australia right now. Operation Claw.
Operation Claw, yeah. So the Australian Transaction Reports and Analysis Center, AUSTRAC, along with their prudential and securities regulators, they've launched a massive coordinated investigation into 10 major Australian banks.
10 of them.
10. They have identified hundreds of millions of dollars in property lending that is believed to be supported by false or misleading information.
But let's be absolutely clear on the mechanics here, because this is not the traditional old-school liar loan that we used to see.
No.
This isn't the retail borrower taking a bureau and slightly inflating their base salary by $5,000 to get a better fixed rate. This is a professionalized, highly coordinated fraud ecosystem. I mean, Commonwealth Bank of Australia has reported a potential $1 billion Australian dollar exposure to fraudulently obtained home loans.
That's staggering.
And National Australia Bank is separately investigating professional syndicates and has already suspended multiple broker relationships.
The methods of misrepresentation have just completely evolved. Investigators found fully invented business activity, perfectly altered financial statements, and offshore or third-party funds being used to complete settlements.
Right.
But the core mechanism here, the real threat vector, is generative AI. Fraudsters are allegedly using artificial intelligence to forge flawless payslips, employer letters, and bank statements.
But if you think about it, the AI doesn't even need to be exceptionally creative, does it? It just needs to be precise.
Exactly.
Banks have invested hundreds of millions into automated credit assessment and digital onboarding to cut costs. But if an automated system is just a dumb terminal checking boxes, does the income field match the threshold? Does the document have the right pixel layout for a NatWest bank statement? It's like a teacher grading a test solely with a rigid rubric.
Right.
If organized crime knows the exact parameters a digital model requires, they just prompt the AI to generate an application that precisely meets those thresholds.
Yeah, that's the fatal flaw in pure automation. A fraudster who understands the underwriting process knows exactly what the model prioritizes. So a stated income is engineered by an algorithm to be just high enough to satisfy a serviceability test without triggering an outlier alert. The danger is greatest where lenders treat standardized, digitally submitted documents as absolute proof. Underwriting relies on a chain of trust.
It does.
If multiple links in that chain, so the applicant, the rogue broker, the compromised accountant, if they're all part of the same syndicate, a formally documented application will look economically perfect while being entirely fabricated.
And this is exactly why it is an ecosystem risk for the UK right now. British lenders rely on the exact same broker network models, the exact same digital onboarding software, and the exact same customer-provided data. So what is the strategic fix for a UK risk team looking at this Australian disaster? Yeah, because clearly just buying better OCR software isn't going to cut it.
No, not at all. The primary lesson is that data ingestion is not verification. The Australian regulators are urging banks to cross-reference data against authoritative tax records. But UK lenders need deeply layered verification.
Like what?
You have to look for metadata in clusters. So are you seeing repeated applications linked to the same broker where the PDFs all share the same creation software metadata? Are there common document templates with suspiciously similar phrasing coming from entirely different postcodes? The control framework has to connect credit assessment directly with anti-money laundering transaction monitoring to spot these synthetic identities.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you. Okay, so moving from the retail lending side, it's really fascinating to see that the wealth management sector is experiencing its own sort of structural crisis right now. It's undergoing extreme consolidation, and frankly, the cracks in their compliance frameworks are starting to look like massive structural faults.
The FCA just published their Wealth Management Survey report for 2026, and the data is just staggering. The sector has become hyper-concentrated. The top 10 firms by client numbers now serve 89% of all discretionary clients.
Which is huge.
It is. That is an industry managing roughly £1 trillion in assets, and that top 10 concentration is up 19 percentage points just since 2022.
But here is the part that genuinely blew my mind reading this report. Despite that massive institutional scale, the FCA found severe financial crime control gaps.
Yeah.
We are talking about foundational day one compliance failures here.
Yeah.
26% of surveyed firms don't even collect expected transaction frequency data,
Unbelievable.
and around 10% fail to verify the source of wealth. I honestly can't believe this. How does an industry managing £1 trillion fail to ask where the money came from? It feels like a too big to check paradox.
Well, it comes down to the mechanics of that consolidation you mentioned. When Firm A buys Firm B to capture their assets under management, they often just migrate the client books without migrating or reconciling the legacy KYC data.
Oh, I see.
Right. They treat anti-money laundering checks as administrative friction that just gets in the way of the acquisition rather than an actual security mandate. So they end up inheriting thousands of high net worth clients whose source of wealth was jotted down on a piece of paper in 2014 and just never digitized.
And if you connect the dots under the consumer duty, failing to verify where a client's money comes from isn't just a technical breach, it is a spectacularly low-bar failure, especially when the FCA Director of Consumer Investments, Lucy Castledine, is issuing incredibly blunt public warnings about this.
And she is. The regulator also looked at AI adoption in this space, which adds fuel to the fire. Currently, only 13% of these wealth firms use AI tools, but that figure is projected to nearly quadruple to 45% very shortly.
Wow.
The message from the FCA is crystal clear. You cannot even get basic source of wealth checks right, so do not deploy complex AI tools until you fix the basic plumbing. For any retail bank running a private banking or wealth advisory arm, firms need to benchmark their financial crime controls today before the FCA launches its next thematic review.
Well, and when those institutional control frameworks fail, whether we're talking about mortgage underwriting or wealth management, the regulatory response has fundamentally shifted anyway.
It has.
The FCA isn't just satisfied with levying a massive corporate fine anymore. They are aggressively hunting down the individuals at the very top.
The senior managers regime is finally baring its teeth. The FCA is demonstrating that personal liability is absolute, and the courts are backing them up.
Look at the sheer scale of this accountability crackdown. Barclays is currently facing a high court claim for up to £2 billion from investors, who are represented by the litigation fund Woodsford.
Yeah.
And the mechanism here is fascinating. The investors allege the bank actively deceived them over former CEO Jes Staley's ties to the late Jeffrey Epstein. Staley was already hit with a £1.1 million fine and a lifetime ban from the city.
Right.
But the investors claim they suffered massive financial losses across 3 distinct stock drop events when the truth eventually leaked out, including when Staley resigned in 2021 and when the FCA issued the lifetime ban in 2023.
And we see this individual accountability extending well beyond the bulge bracket banks, too. Look at Dimitrios Hadjigeorgiou, the former CEO of SVS Securities.
Ah, yes.
He was fined £56,400 and handed a senior management ban. The mechanics of what happened under his leadership are essentially theft by spreadsheet.
Yeah.
The firm invested retail pension savings into high-risk products while secretly taking a 10% commission on fixed income products.
But it gets worse, right?
Yeah.
Because when customers actually wanted to sell their bonds, he failed to challenge a decision that introduced a hidden 10% markdown on those disinvestments. It wasn't a fee they could see, it was just baked into the price.
Exactly.
That generated over £350,000 for SVS, directly at the expense of its customers' retirement savings.
It's shocking. And then there's Howard Duckett at Buforce Corporation, which is a debt management firm. He was handed a 10-year director disqualification by the High Court and a total FCA ban for fabricating records, lying to the court, and literally claiming a fictitious person was responsible for running the business.
A fake person?
A completely fake person.
I mean, the FCA is acting like a nightclub bouncer who has stopped throwing out the unruly patrons and has decided to go directly into the VIP room to drag out the club promoters and the owners instead. It is a brutal shift in tactics.
It is a vital reminder for anyone holding a senior management function. You just cannot hide behind the corporate veil anymore. But, you know, the FCA is also dealing with massive external threats to consumers right now. They've issued over 1,200 warnings in 2026 alone about unregulated mini-bonds and loan notes.
Which is the exact same category of high-risk product that fueled the London Capital and Finance scandal.
Exactly, because the scammers are exploiting a very specific engineered loophole. They heavily encourage victims to self-certify as sophisticated investors or high-net-worth individuals.
Right.
The moment a retail consumer ticks that box on a web form, they legally strip away their own standard regulatory safeguards. We just saw the collapse of Woodville Consultants Ltd., a litigation funder that raised capital through these unregulated loan notes, showing the total risk of capital loss.
There is also intense scrutiny on Octopus Group regarding their inheritance tax service. Critics allege they used funds from 18,000 pensioners to bankroll their own struggling hospitals and care homes via a related entity called Fern Trading, leading to a £42 million loss after a loan was written off. So what is the practical takeaway for a retail bank that just processes the payments for these things?
The critical takeaway is proactive disruption. Under the authorized push payment fraud reimbursement rules, banks processing payments out to these mini-bond scams must proactively spot the red flags, like sudden fixed high returns or pressure to self-certify and disrupt those outbound payments before they happen.
You can't wait for the complaint.
No, you cannot just handle the complaints after the money is gone. The liability sits with the banks to stop the outflow.
Okay. Finally, let's look at the ultimate test of regulatory boundaries, the cryptocurrency sector. We're currently watching a massive structural divergence between how the United States and the United Kingdom are trading digital assets, and frankly, it's going to dictate where the capital flows for the next decade.
The momentum in the U.S. is entirely legislative right now. And just to report on the source material here, President Trump hosted crypto executives at the White House, including leaders from Coinbase, Kraken, and Ripple, urging Congress to pass the Clarity Act.
Right.
The mechanism of this bill is crucial. It seeks to legally distinguish digital commodities from securities, which brings them firmly under the authority of the Commodity Futures Trading Commission, the CFTC, rather than the SEC. And the Senate has scheduled a procedural vote for 15 September.
And the market reacted immediately to the prospect of actual structural clarity. Bitcoin surged past $70,000, trading near $72,600 on the news.
Yeah.
The U.S. is actively trying to build a clean market structure law to keep ahead of global competitors. But in stark contrast, the UK's approach right now is incredibly enforcement heavy.
It really is.
HMRC sent over 81,000 warning letters to crypto holders in the 2025-2026 period. That's a tripling of their previous enforcement activity.
Yeah.
And by 2027, international crypto platforms will be forced to share customer data directly with HMRC to tax capital gains.
And that divergence creates acute competitive pressure, because the FCA's comprehensive crypto regime doesn't fully kick in until October 2027. If the U.S. provides a clear statutory framework for digital commodities right now, global platforms and institutional capital will simply bypass London entirely.
Yeah.
The American regime will just look far simpler and infinitely more attractive to institutional money.
It honestly feels like the UK strategy is playing an endless game of whack-a-mole with tax enforcement letters, while the U.S. is actually building the arcade. Are we just engineering a highly efficient tax trap while the real market structure moves to America?
That is the exact risk. And for UK compliance officers, the immediate action item is to review your U.S. Nexus exposures right now ahead of that 15 September Senate vote. You need to check whether your current FCA crypto registration adequately covers potential CFTC-style commodity treatment of tokens across borders.
Right.
Because if the regulatory clarity shifts across the Atlantic, the risk appetites of UK banks providing accounts to these crypto firms will have to radically shift as well.
Okay, let's bring all of this together. We've covered a massive amount of ground today, from AI fraud to macro headaches. What are the absolute vital takeaways for compliance, risk, and legal teams listening right now?
Swiftly, there are 3 immediate priorities. Number 1, stress test your mortgage affordability models against a split Bank of England that might hold or hike, and do not rely on the US Treasury's tactical duration swaps to permanently suppress yields.
Yep.
Number 2, urgently review your automated underwriting models for AI-forged documents, particularly within broker channels, treating mortgage fraud as a coordinated ecosystem risk that requires layered verification.
Absolutely.
And number 3, plug your source of wealth and transaction monitoring gaps immediately in your wealth portfolios, because the FCA will not tolerate basic compliance failures in a market where 10 firms control 89% of the clients.
Excellent. And here is a chilling concept to leave you with, combining 2 of our major stories today. We noted that wealth managers are eagerly rushing to adopt generative AI, with usage projected to jump from 13 to 45%. But what if that exact same generative AI technology is currently being weaponized by the criminal syndicates we saw in Operation Claw to systematically bypass those wealth managers already failing KYC and source of wealth checks?
Yeah.
We aren't just looking at a regulatory gap. An AI arms race is happening right under our noses, and the banks might be bringing a spreadsheet to a drone fight.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.